Hello and welcome to ETEnergyWorld. I am Sudhir and we are today talking to Mr. Ashok Haldia, the MD and CEO of PTC India Financial Services, one of the major power sector lenders. Welcome to ETEnergyWorld, Mr. Haldia. Can we begin this discussion by you giving us an idea of what is PFS all about and what have been some of the key highlights of or the achievements of PFS's growth history over the past more than a decade, I believe?
PTC India Financial Services, known as PFS, is an infrastructure finance company. Under the NBFC, which are regulated by the Reserve Bank of India, there is a separate classification of infrastructure finance companies, which are relatively larger NBFC and which are focused on infrastructure financing. And we are one of the first few infrastructure finance company in India to be recognized as such. We were set up around 2007. And thereafter, we started financing the power projects, first to start with the thermal, and then gradually we moved into the renewables, and now from renewables, we are also diversifying, of course, in a calibrated manner into other infrastructure sector, like road, ports, and the infrastructure, logistics, etc., etc. So we were first of the institution in India, if I can say so, which was exclusively devoted to financing power projects, particularly in the private sector. And
not just that, but equity investments also.
Yes, not only that and equity, but also the debt and equity related structured products. And over a period of time, as you all know, that we have gross effective sanctions made more than 20,000 crores. Our gross disbursements exceed 15,000 crores, and our book today is around 10,000 crores.
The loan book position?
Yeah, loan book position is around 10,000 crores. So we have grown over a period of time, and last 10 years have seen a lot of challenges for the power sector as well as the financial sector.
Okay.
So we as a financial institutions gets affected not only from what happens in the economy in general, but also what happens into power sector in particular, and also in the financial sector in particular.
Exactly, and I was coming to that. These days people are talking about, every day there are concerns being raised about how lenders are worried on bad assets, and that is particularly true for the power sector, because I believe that accounts for a larger chunk of the total bad assets in the banking industry. Now, for companies like you, can you give us a sense of to what extent that problem has impacted you, and if yes, then what are the strategies that you would have worked upon to work around that problem?
The stress assets is inherent in the business of a financial institution. So you cannot say that I am a financial institution, I would not have any stress, despite the economy or the power sector or the financial sectors may be undergoing a stress situations. Okay. The only thing that you can do as a sensible institution is to be more prudent. Having said that despite the chances of stress would always remain, and so is the case with us. Yeah. So we have a stress assets. We have the NPAs with us, and which NPAs, I believe, as on the last quarter was around more than 4.5%.
Okay.
And the net NPA was more than about 3.2%. And of our total loan book.
What I was trying to ask was, has the sector become more stressed in the past, let's say 2 years or 3 years? Is the general level of stress higher or lower than what it was?
Obviously, I would say if I compare over the period of 7 years, 8 years, the stress level increased, because when we started financing for the thermal power projects, we all financed in the expectations of so many happening that things would take place. We were funding in the arena of uncertainties, not in the arena of risk. Okay. Because we were saying hopefully there would be demand, hopefully their PPA would be signed, hopefully fuel supply agreement would be signed, hopefully coal would be available, hopefully there will be no transportation logistic problems. So those were uncertainties with the finance. Now as the things evolved,
those did not materialize.
Yes, those things did not materialize. I would not say the things have totally transformed.
Okay.
But things have changed for the better from more than many aspects. One is that if there is a problem, there are people, there are institutions, there are authorities who would immediately seize of the problem and they would try to address that problem.
Can you give an example?
For example, if there was a coal problem, the government of India took that initiative, and now you see the coal is in the surplus and the power sector projects now have an inventory of inventory of more than what was earlier considered to be critical. So they have enough inventory. The coal logistic, transportation logistic problem, logistic is far more easier and rational today than what they used to be. We have the stress assets. There were RBI norms on the stress assets. RBI have come out with dispensations to facilitate the lenders to deal with those. We have now the bankruptcy law, which empowers the lenders to deal effectively.
Now, can you explain to us how, as a company or as a lender, you have responded to this, larger concern of bad assets? So, for example, I'm told that the company is, has been working on a strategy for diversification. Now, what is that strategy all about? How has it worked? Has it not worked? To what extent you want to, take further steps to ensure that it grows? Can you tell us more about that?
First at a strategic level.
Okay.
So, like for example, when we started, our focus was more on the thermal.
Okay.
But then we thought way back in 2008 that maybe the future would lie in the renewables. So we took a strategic view that, and we started positioning ourselves from 2008-9 itself, and we were possibly first of the lender, financial institution in the country to provide financing to the renewable power projects.
Okay.
Amidst those known and unknown fears surrounding the renewables. To that extent, we broad-based our risk profile from purely to the coal-based projects, moving to the renewables. And when the renewables got stabilized and we had a good books, and we became one of the leading institutions to finance the private, the renewable project in the private sector. Then we thought that the challenges in the power sector, and then if you are completely focused on the power sector, then that might affect the growth of the organization as well as the propensity to stress in the portfolio.
Yeah. Okay.
So we thought that it's an appropriate that we take a calibrated approach, and I would emphasize the calibrated approach to move from the power sector to the related areas. For example, we said that we'll go into the roads, but the roads, not all kinds of roads, but only annuity-based roads, or under the HAM. Or we said we'll move into the ports, but the ports, only those ports which are established, and we know the track record of the cash flow and the operational viability.
But the
of those
returns
projects
are relatively
yes.
No,
we fairly know about the risk profile of that project because that's an up and running, and they are coming for the expansions. And then we also said that many of the coal projects would require the connectivity. So we earlier financed the projects linking the coal mines to the power projects.
Okay.
So the rail connectivity we did fund. We also financed for the mine developments, coal mine developments. Now, drawing out of the experience of that, we have started financing the rail connectivity, say from the port to the main hinterland.
Okay.
We also finance certain CFS in the past, infrastructure logistics. So those are the areas, and then we move from the generation to the transmission.
Okay.
And the energy efficiency, financing the energy efficiency. So that's how we are trying to broad base so that all eggs are not into the one basket.
And all of these are in addition to renewable, right?
Yeah, obviously, in addition to the renewables.
So talking about viability of renewable energy projects, risk profile being relatively smooth now. We have just seen a sub ₹3 per unit tariff bidding for solar and even wind projects. Do you think tariffs are at this level are viable? I'm asking this because there is a very strong body of opinion that in solar's case, for example, they may not be viable for the simple reason that the entire calculation is based on so to speak, artificially low module prices. Now, in such a situation, firstly, do you believe in that analysis, or secondly, as a lender, how do you look at this entire situation panning out?
No, if I go back 6-7 years ago and what was going on in our mind, at least I'm sure I know in my mind it was very clear that the tariffs would fall, and a time might come when they might fall steeply because the capex would come down. The risks or the perceived or known or unknown risk around the renewable power projects would get crystallized, known, and would be addressed. So it's not nothing new that when the prices are declining, that it is coming as a surprise or shock to us. We were knowing that this would come down. We were also knowing that a day would come that they would get a grid parity, maybe they would become cheaper than the other sources of power. So if you ask me, I was not taken by surprise that the rate can go down. Now another question, I mean, rate will go down and go down to that extent. And if you ask me, these rates may be in for further decline in the next 6 months or 1 year. But your another question is to what extent these rates are viable. And I often maintain that the viability is a relevant question. You cannot answer into absolute terms. It's a relevant to a project.
It depends on project to project.
Yeah, it's a relevant to the project.
Okay.
Now, if someone has bid, and also to the promoter, because they have a risk profile, they have their own strengths and weaknesses, they have their own strategic perspective, and they have their ability to absorb the risk. So within that framework, they would bid. Now, one would presume that they have bid in a rational and a prudent manner, and they are all well-known players domestically and internationally. Okay. So now, if they have bid, now I have no reason on the face of it to say that these prices, at this price, they are not viable. But as a lender, when these projects comes to us, our due diligence would like to see as to whether these tariff bids would be viable or not. Now, what we will do is, we'll look into the cost components, the capex cost components, and we will see to what extent these are reasonable, to what extent these are firmed up, what is the element of uncertainty, and what is that element of uncertainty the impact might have on the overall cost and the viability of the project. Now, if all these costs are firmed up and they have a EPC contract in place, they have a supplies also ordered at and the rates are firmed, and they have the equity in place, then I have no reason to believe that these projects may not be viable. And then remember, many of the risks in these projects have been addressed by the bidding authorities themselves. So you have a solar power, your land risk is taken care of, your evacuation transmission risk is taken care of, evacuation risk is taken care of, and then you have a payment security mechanism, which is far more sturdy than the payment security mechanism.
Finally, sir, what is your sense of the larger distribution reform that the government has been working on? Uday has been that has been under implementation for more than 2 years now, I believe. Do you see things changing on the ground? I'm asking this because distribution reform is ultimately the thing that if it doesn't happen, then it starts impacting generators and it starts impacting you. Now, to what extent do you see the fruits of the entire Uday scheme, for example, getting realized?
No, at a very crude level, if you ask me the impact, I can only assess in terms of whether the payments to the plants are coming in time or not, or whether the delay that used to take place earlier that has reduced. No, answer is certainly yes.
The problems have come down.
Problems have come down. So the delay those were taking place have reduced significantly in most of these states, be it Madhya Pradesh, be it Rajasthan, be it Tamil Nadu, be it Karnataka, be it Andhra. So the delays have reduced.
So is PFS capitalized enough at the moment, in the sense that are we, what are the larger plans for fundraising that we're working on?
We recently raised 300 odd crores. The parent company infused into the PFS. Okay. So our capital adequacy ratio is around, I believe, 26-27%. That's fairly good. Okay. And obviously, because that equity has come recently, and this should support our growth level because we can, as under the RBI norms, we are required to maintain minimum capital adequacy ratio of 15%. So it's fairly good, and it's needed also. Because we need to grow. It's a growing business and the money is the raw material for us. And the board had allowed us to raise up to 750 crores as a capital. We have already raised 300 odd crores. So we'll continue to see our requirement, and
the rest of it will happen over what period of time?
No, the board has already empowered us, and we will see as to how our requirement evolves and develops, and accordingly we would.
So
move
can
forward.
we say over the next let's say 6 months or so, we are or
I
one
mean,
year, we are looking at 3 to 400
difficult
crore.
and not prudent to answer.